It's common to hear prophets of doom warn of dangerously overpriced markets. In fact, just such a warning was issued again in late January by the famed Jeremy Grantham, much as he did the January before. More often than not, heeding such warnings has been costly, since the very assets said to be poised to tumble instead just continued to power higher, leaving the cautious in their wakes. But what if this time the odds are stacked so one-sidedly against further gains that the warnings are justified now? Might U.S. stocks, bonds, real estate, and maybe even commodities now simultaneously all be in super bubbles, just like those that preceded the U.S. stock market crashes of 1929 or 2000, or the crashes in the Japanese stock and real estate markets of 1989? If so, what steps could you take now, not only to protect, but possibly even to grow your wealth? Stay tuned as we explore all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. We've got a great episode for you today. Adrian, how are you feeling? You ready to go? Anything new last week for you?
Nothing new last week. I'm looking forward to this episode. It's going to be a really solid one. It's going to have a lot of great content. I can let Erik lead us right into it.
All right. Well, fantastic. So, dear listeners, today our topic is super bubbles and various asset classes. And we're going to spend some time, first of all, defining what that actually means, and then talk about whether or not we are in one or more super bubbles, and then talk about if we are or we are not, then what are the implications of that for how you ought to grow and protect your wealth. And the reason that we think this is important is that there's always talk about where we stand in the markets, whether this is a favorable or unfavorable time to be investing. That's a constant source of conversation for all of us. But it's particularly, I think, awakened when one of two things happens. Number one, when we have a sudden downturn or a relatively swift downturn like we had in the early part of 2000 in response to the COVID pandemic. And then also, as we've just had more recently here from, let's say, essentially mid-November in some asset classes since mid-March maybe of 2021 in various other asset classes. And people start to wonder, wow, is the party over? Is the long bull run that we've been part of over? And so that awakens a lot of conversations as well. And one such prominent catalyst for these conversations is a fellow named Jeremy Grantham at GMO. And he published, as he is wont to do each January, another forecast of where things stand, both on the basis of their asset class forecasts, but also just on a big global picture. And he invoked the term super bubbles. And in fact, the article is titled "Let the Wild Rumpus Begin." And so, as a result, suddenly the airways lit up, and the blogs lit up, and all sorts of things like this lit up. And as for that matter, gentlemen, maybe your email inbox, and maybe your phones have also lit up recently with clients wondering what's going on and where do we stand. So we thought it's useful for us to reflect on the question: are we in just sort of a normal pullback right now within the context of a normal long-term market? Or are we at really elevated price levels in a variety of categories? And is this initial downturn that we've seen, is it just a prelude to something that's much larger? Being able to answer that and then arrive at some decisions about how you might safeguard your portfolio or take advantage of that downturn. Both sides of that question, by the way, are important, but we see that as really part of the conversation that we want to have with you, our listeners.
Yeah, I think Jeremy Grantham is very well known for us as far as investment professionals go, and he's releases that expectation, as Erik, as you said, annually. So when he talks, people listen. What's interesting though is I believe he's been talking about this specific super bubble for well over a year, maybe even longer. Is that accurate? When's the
Mhm.
first time you saw him speak of it or heard him speak of it? Excuse me.
Well, in January of 2021, he was warning, though not with as much, not as vociferously as he is now here in January of 2022.
Yeah, and I believe I'd listened to an interview with him a little while ago,
Mhm.
so I may not recall it correctly, but I believe he had called for something similar, not the same, but similar, prior to the pandemic, right? As things were up in the markets, and then the pandemic hit, and then you had a Fed response, and that combination had him saying, "Okay, things have changed at least temporarily," and then back at it again in January 2021. I'm not trying to minimize what he says at all.
No.
He's brilliant, but uh, he has been saying it for a while, and I don't necessarily. I'm not saying he's wrong. I guess what I'm saying is if you call for a bear market and a decline long enough, eventually you'll be right.
Yes, I
Right?
understand that. The article that they published in January 2021 was called, similarly ominously, "Waiting for the Last Dance: The Hazards of Asset Allocation in a Late Stage Major Bubble." Now, they weren't calling it a super bubble, but they were calling it a major bubble.
Major
And
bubble.
the concluding paragraph of their executive summary said, "But this bubble will burst in due time," et cetera, et cetera, et cetera. So yes, this is a recurring theme for GMO and Jeremy Grantham. There's no question about it.
Yeah, and as I said, and I want to make it clear to the listeners, I'm not necessarily saying he's wrong. And Eric, you've done a good job, a great job, I should say, with some of the data you've pulled, comparing the whether we are or whether we aren't, and what the data points were. And I know you're going to share the data that you have, but do you mind sharing your conclusion, or and I'll sort of nudge you in that direction? You were just saying that it makes such a difference what you're using as your source, right? What
Hmm.
are you using to define a bubble, statistically speaking? And can you
Hmm.
talk about the different comparisons you made and what you were saying? Because I think this is very important to how you approach what Grantham is talking about.
Sure. All right. So let me just, out of respect for Grantham, and also just to help you, our listeners, understand this, the article that was published this January was titled, as I said, "Let the Wild Rumpus Begin," but the subtitle was "Approaching the End of the First U.S. Bubble Extravaganza: Housing, Equities, Bonds, and Commodities." So we're talking about this, although much of my reaction to this is going to start in the area of equities, U.S. equities in particular. Let's just make, in fairness to him, note that they really, GMO, are looking at this in a much more sweeping way than what I did. But here's the question. Um, they define they define super bubble statistically, and the statistical measure that they use. Think, all of you, back to your that statistics class you took once upon a time, and the concept of what's known as a standard deviation. So, just for those of you who said, "Wait, I never took a stats class," let me just summarize this in the simplest terms. If you think about the bell curve, you've heard the concept of the bell curve, and in the middle of that bell curve is the average, or the many times maybe the median. But not everything clusters right at the average or at the median. You have some things that are above the median or mean, and other things that are below. So the standard deviation measures, at least in a normal distribution, roughly roughly what, um, one third of the things that are above normal fall in the first standard deviation. Another third fall in one standard deviation below normal. The next standard deviations out encompass another roughly 14% on each side, and so forth. So by the time you get out to two standard deviations away from the norm, you have really only on either end about 2.5% of the overall observations left. And if you get to three standard deviations, now it's just an infinitesimally small number of instances. So they're saying is 3 standard deviations if we had a truly randomly distributed set of price variations in various markets, stock markets, bond markets, commodity markets, housing markets, et cetera, then this three sigma departure from the norm, or this extreme departure from the norm, would only occur every 44 years. As it happens, human beings don't behave entirely randomly. Markets aren't entirely random. And so, in fact, these 3 sigma events occur maybe every 35 years. And these just quick examples of them: the 1929 bubble, the internet bubble, in Japan, the 1989 bubble, and so forth. So, but it all comes back to how you define normal and then how you measure what is a standard deviation. So, in my own case, in preparing for this podcast, I said, well, what are they using? And so they define it as trend and then measure departures from trend. Well, trend can be defined in a lot of ways. Is it trend from the inception of time, at least since the inception of the US stock market or a US bond market, or measurable amounts of commodity or housing or what? Or is it the last 40 years? Is it the last 20 years? What is trend? And then separately, what if you don't use trend? What if instead you use a moving average of price? So I looked at, for example, the 10-year moving average of the S&P 500's price, and then how far or above or below that are we, measured again in standard deviations. I looked at another tool or approach called a growth, projected growth based on a normalized growth rate, and so forth. And what I found was that the choice of what you use to define as normal can make all the difference in how truly abnormal you believe we are right now. For example, one of those 3 measures that I used, I talked about growth, trend, and 10-year moving average. One said the markets right now should be the S&P 500, which is currently at about, gentlemen, maybe you're looking at it, I think it's 4,300, 4,400, somewhere in there right now. Maybe normal should be at 1,670. Another would say it should be at 3,000. Still another would say it should be at about 2,600. So you can see that depending on your choice of those, that alone would make for wide disparities or disagreements, at least, about the measurement of this. Out of respect again for Grantham and GMO, what they've said is what they believe normal should be right now on the S&P 500 is 2,500. 2 standard deviations, that's 2 sigma, would be 3,500. 3 sigmas would be 4,500. And incidentally, in December, we were at almost 4,800. So that's their argument, is we're way above, or at least we were at the point in time in which they were publishing this article, way above what should be considered normal.
Yeah, there's also another technical term that some people might be familiar with, and this kind of blurs the lines on what you're saying, Eric, but regression to the mean. And if some of the people that aren't familiar with that, let's just say you have a stock that's trading just inching a little bit higher, it's trading from 50 to 60 for a long time, it's kind of bouncing around that range. And then the past couple weeks, it's just run up to 100 or 150. One concept, one theory is regression to the mean, that at some point it's going to come back to that original average level of the 50 and 60. And that's something that people are looking at today. Is that going to be something that's going to be happening depending on what market or what sector or what asset you're looking at? Is that a possibility where a regression of the mean's happening, where it's kind of got away from this price level it's been at for so long? Is it going to move back down to this historical average it's been trading at for so long?
And in GMO's case, their argument is the way these things usually work is, at least in normal times, is that when they finally decide, hey, we're way out of whack here, when markets sort of get that figured out, they don't just go back to the mean, or the trend, in this case is the language that they're using, they overshoot that. And they deviate to the in the opposite direction. It can go in either way. So at this level, you start to say, okay, well, it'd be nice maybe to just get back to trend, but will it stop there?
Yeah, and one thing that's important as you talk about that, Eric, is um, I believe Grantham has said, looking back, that even in 2009, we were just barely at the fairly to undervalued
Hmm.
place,
Right.
right? So that being said, um, is that then just getting back to trend? Is he saying in 2009 when everything crashed, markets got cut in half, we just got back to trend and they weren't cheap? The markets weren't cheap?
That's right. That's exactly the argument they're making. Maybe it was a slightly on the cheap side, but it wasn't. It wasn't. It didn't make that full kind of counter move, going equally past the trend to the downside as it had been to the upside. It just came back to trend.
And the markets, hypothetically, we're in '09, and you're seeing that data and you're saying things aren't cheap, so I'm waiting. Now we are 13 years later. It's never gotten cheap. The markets have gone up 6 times.
Right. That's the
So,
challenge, isn't it?
and I know you're not Grantham, so I'm not asking you to put words in his mouth. But there are two things that I find difficult difficult with this, and I'm not by any means saying I think the markets are cheap or that he's
Hmm.
wrong. I just
Hmm.
have a little difficulty grasping this. The first is if you're waiting till things are cheap, based on his analysis, you're essentially waiting for when? For the last 20, 30 years?
Yeah, it is really. That is the predicament, and that is coming back to the to those other measures that I was using. Maybe a better measure is just, well, what's the 10-year moving average of price or maybe what's the 5-year moving average? Something else that is more related to, has some sort of recency to it
Hmm.
that reflects where you are, so that you can at least say, well, maybe I'm not cheap in the big scheme of things, but I'm at least in a micro sense, I've gotten cheap. And so now I have an opportunity as part of this overall expensive market to buy at some slightly less expensive time. You're absolutely right, though. That is the predicament, because right now, for example, and just to say, hey, Grantham has, we dinged him a little bit because every year, I think it's fair to call him a perma bear. I don't know that he would say that's fair. I would think he would say, I'm not just or dispositionally bearish. I am analytically led to the conclusion of being bearish, but he fully acknowledges that he's been wrong. Actually, the language that a lot of these people use isn't that I'm wrong; it's I'm early. So
Yeah.
he did have the housing market. He did correctly predict that was way overdone, and he also correctly forecast a decline stemming from the internet bubble bursting. But since they issue these 7-year forecasts every year, if you look 7 years ago, so that'd be 2015. At that point in time, they were projecting negative real returns over the subsequent 7 years for the U.S. stock market, and in fact, we're much higher. So not only were they off in terms of, they under or overestimated it, they were completely directionally wrong. And it's conceivable, of course, and which he acknowledges, that they may be directionally wrong as well. Now, I do think, and I don't want to do this right now because I want to let you guys have some other input on this, but I do think it's important to share with our listeners that there's more to his argument than we're just overvalued. He's seeing some behavioral things in the markets that he thinks are also indicative of this super bubble property.
And let's come back to the behaviors because I have one other question I want to ask you and get your thoughts on.
Hmm.
I understand the numbers behind it and the
Hmm.
statistics behind it,
Hmm.
but when you tell me this is a three sigma event, and I thought he had said that that's a one every 100-year occurrence.
Every
Three
35
sigma.
years, they say.
No, that's when it actually happens, right?
Oh,
Isn't it's a greater number for what it's supposed to be?
yeah, I think they had said, if their prediction was that those sorts of events will happen every 44 years if it was a totally random setting, but it doesn't.
Yeah.
It's not.
And so when you tell me it's supposed to happen, and I don't expect them to have a
Hmm.
science down to it,
Uh huh.
but when you say, well, this is um, a a once in 100-year event. I'm using 100-year because I think I'm thinking of Talib and the Black Swan that he's saying.
Okay,
But
sure.
so the time frame is not important. But if you tell me this is supposed to happen once every 100 years, but it happens every 30 years, or every 20 years, how useful is that information beyond an intellectual exercise in terms of I'm saying how useful is that in the practical world? And I have a quote for you when you mentioned Grantham being too early. This is by Howard Marks, who's from Oak Tree Capital. He's well known in the investment space, but his quote is, being too far ahead of your time is indistinguishable from being wrong. He's talking about it from an investment perspective. But back to my question, can you help me utilize this information when I first see it's supposed to happen every X amount of times, but it happens a lot more frequently?
Well, first of all, I do want to say I just now looked in the article and my memory didn't serve me well. So I wasn't early, Roshan. I was wrong.
Okay.
You were right. The 2 Sigma event is every 44 years if it's random, and every 35 years if it's not. But the 3 Sigma event, as you're right, is even rarer still. So, but
Well,
nevertheless,
it's
we've gotten
supposed to
more
be
than our
every
share.
100. Yeah, it's
Yes.
supposed to be every 100, but I thought they said it's happened 4 times in the last 100 years.
Well, certainly 1929, 2000, Japan in 1989, and they would argue also here now.
Right now. Okay.
Yeah. So, but anyway, coming back to, so restate your question.
Why do I not throw this analysis in the trash when you tell me something's supposed to happen every 100 years and it happens every 25?
Well, I'll take a shot at it,
or
Roshan.
4 times in 100 years.
I guess I'll take a shot at it, Roshan. I think I wouldn't like throw it out the door because I think it's more of a data point that people should look at and then just kind of consider it or hold in the back of their pocket saying, all right, if this is supposed to happen X amount of years, let's just see how much exposure I have to like different areas, different sectors, where are my assets and investments all tied up to? And then this kind of brings in the question of just diversification, where let's just say somebody didn't have this data or didn't know that this was going to happen X amount of years and just kind of went with the whole aspect of, oh, the markets had just been going up. Oh, it's not a bubble. I don't have to worry about it. Where the people that do look at it, do consider this, kind of make some reevaluate, update their plan, look at their portfolio and say, okay, if this is supposed to happen X amount of years, what can I do to kind of protect myself? I think is what you can really take away from this at the end of the day.
Well, because I guess what I'm thinking is if I'm retiring and you tell me this is supposed to happen every 100 years and I've got 30, 40 years left in my life, why do I care about it? I'm not saying you shouldn't by any means. I'm being the devil's advocate to
Sure.
the extreme right now.
Right.
But that is something I think about when I read it, right? When I read this thing. And to be clear to both of you and everyone listening, I'm not saying you should throw this in the trash.
I understand that. But so let me respond to the person who might be saying you should, because there are, in fact, some people who say that. So one argument is, well, when they happen, especially if they happen on the cusp of your retiring, they're consequential. So if you had retired in 1928 or 29, it would have taken you a long time to see your portfolio come back. If you had retired in 1999, and I have a friend who retired in 1999 and then had to resume working in 2004 because things had come down so much in what he'd assembled, then that was consequential for him, and he's working until even now. So isn't that so? He extended his working years by 22 years. It's also the case if you were in Japan in 1989, but there you had jointly a bubble in real estate and in the stock market. Real estate is still down from where it had been by at least 25%, and that's after it's quote unquote come back. And the stock market is barely coming back to the point at which it had reached in 1989. Think about what that did to a generation of retirees in Japan. Now, I think in Japan, more people have had, at the time at least, corporate pensions, but still, those sorts of things matter. So if many of our listeners are thinking about retirement, that's what the show is about. If they were dealt a hand where they were just blindsided by a substantial decline in their portfolio, that would change what they're able to do and what they're not able to do.
True. Agreed.
So, I mean, I think it's just it's the magnitude of the consequence that leads people to say, well, if I this is one thing I don't want to get wrong, as opposed to just, it happens every 100 years and it's not that big a deal. Actually, it seems like it's happened more often, different parts of the world, and certainly here in the United States. His argument, GMO's argument would be, we're at instance number 3 in the United States alone in the last 100 years. This is something that we should try to devote some attention to and give thought to and understand what the implications are. So I think I wanted to mention a few other indicators that they say beyond just the price levels that they think signify that this is a super bubble. Is this a good time to talk about those?
Yes.
All right. So one of the things that they talk about is what is known as a blow off top. That is, in the late stages of a bubble, what you see is even a further acceleration in price levels and in growth of whichever market is being examined. In this case, let's say stocks or bonds or housing or commodities. And in our case, the growth rates, if you say 19, 20, and 21, you had growth rates in those phases, even with COVID hitting, where you had somewhere in the neighborhood of 20 to 25% growth rates in some U.S. equity markets on a compound annual basis. That's so far above normal. And so
Yeah.
they would use that as, well, that's a warning sign. It's not definitive. It's not every time you have a 3-year run like that spells super bubble, but it is if you're already at elevated levels and then you get that on top of it, they would say that's a warning sign. Another warning sign has to do with the narrowing of the market. So if you look particularly, let's say, at the NASDAQ 100, the NASDAQ, listeners, if you're not familiar with that term, is a subset of the U.S. market, usually large technology-oriented companies, not exclusively, but for the most part. And if you take the NASDAQ and growth stocks, generally speaking, have been having a really fabulous run over the last 13 years, much more so than the general market. But in this latter stage, most of it is in what I'll call the fan mag stocks. Fan mag would be Facebook, Apple, Netflix, Microsoft, Amazon, and Google. And so if you take those stocks out of the NASDAQ and then look at how the NASDAQ has moved, it's been nowhere near the same. So it's been some of these, very, very small number of names, although they're gigantic companies. And so when they're assembled within a market capitalization weighted index, it makes it appear that overall the market is healthy. Actually, breadth is quite thin right now. A similar demonstration of this narrowing is just the kind of crazy behavior of some. I think I can use the word crazy. Some of our listeners won't like this, and I apologize to you if you're offended by it, but some of the crazy behavior about, let's say, we were talking about meme stocks a year ago, AMC, what was the other one? GameStop. We were talking
GameStop
about
was a
those.
big one. Yeah.
Yeah, GameStop. Those stocks just rose spectacularly. I think with companies with very, very few earnings. So what leads to that behavior? That behavior, that indifference to price and to earnings and to real value, is also typical of late stage of bull markets. And in this case, they would say that's a bubble. Here's another example: SPACs. That's special purpose acquisition companies, or SPACs. Basically, they're a blank check company. But they raise a bunch of money on, the good name of someone who has a good reputation, and they say, "Hey, you just write us a blank check, and then we'll go find something to buy with it." Well, in other words, people are just doing that entirely on trusting the name without any knowledge of whether or not what will eventually be purchased is worthwhile. The dirty little secret of SPACs is that inside them, the structure oftentimes is that 20% of everything, not just 20% of earnings, not just 20% of upside, but 20% of everything goes to the organizers of the SPAC. So, why would people do that? It's just rife. I'm not saying there aren't instances where it makes sense, but it is this sort of mania detached from sort of rational assessment of what a company is actually worth. That that's for GMO at least is indicative of these kinds of blow off stages. And then the last thing that they'd observe again, this is just additional elements of their argument above and beyond the overpricedness of markets is what they will call the vampire phase. So the vampire phase is when you start seeing so many things being thrown against the market and it still won't stop. So, for example, you had COVID that attacked the market. That didn't, surely it had an initial very abrupt reaction, as we've talked about many times, from late February to late March of 2020. But coming out of that, even with the pandemic still going strong, and even as recently as Omicron, still taking down a lot of people, the market has just powered higher and higher and higher. You've had the Fed saying we're going to raise interest rates. Market just seems not super excited about it, but still powering higher. The Fed has also said we're going to ease quantitative. We're going to scale back on quantitative easing. Eventually, we've got to taper that down. Market just kept powering forward. So in this case, there's this. It seems like it just keeps rising from the dead. That's the choice of the term vampire. So in other words, they're saying this is not just limited, and I've been using only equity markets in this explanation, but these sorts of things, it's not just limited to price, it's also limited to seeing how market participants behave. And in at least from their vantage point, these behaviors that we're seeing recently are typical of the final stages of these bubbles.
Yeah, and the only one, I guess there are two things I would challenge on there. One is, do you remember how they used fiscal and monetary policy? Like saying that the markets sort of shook off COVID is only accurate, I think, when you consider the massive stimulus that was
Yes,
out there, right?
right.
Without that, if that was held steady, I don't think the market shake off COVID, which they
I
didn't
think you're right.
before.
You're absolutely correct. They do lay a lot of the blame for how elevated we are on all of this at the feet of the Federal Reserve, and that would be going back actually all the way. They would say in this case at least to 1999 and actually earlier. So you might remember Alan Greenspan, for those of you a little older, in 1996 coined the term irrational exuberance in observing what was going on in the markets. Well, markets got a lot more irrational and a lot more exuberant after 1996, and he didn't keep talking about it. And in fact, you had extremely accommodative policy from the Federal Reserve, keeping interest rates low, and at least that was the main thing there, keeping interest rates abnormally low. We would say from a market standpoint, if markets dictated interest rates, we would not have over the last 25 years had the interest rates that we've had. So in this case, they would say what's been done, particularly since the bottoming of the markets at the end of the credit crisis in early 2009 until now, has been astonishingly bad overall from the vantage point of what the the rise in prices will ultimately inflict as pain on a lot of people, in especially not only the decline of asset values as the GMO projects, but also in the difficulty of purchasing a home, which is an interest rate driven now. It's in terms of, you had a 20% rise in home prices, wasn't it, last year? I mean,
Yeah.
that's so much. I mean, we think about 20%. Oh, we think about that in the context of the stock market. It's not uncommon in the stock market. I don't know that we've had a year where nationwide, you've certainly had pockets, but nationwide, you'd have an average home price increase of 20%. What does that do to younger people who are looking to buy a home?
uh, Definitely priced a lot of them out, and I know there are funds out there that have sprouted up that are built upon the fact that people can't buy homes. They buy them
Hmm.
to rent them out because they know people can't buy 'em. That's
Exactly.
their
The
entire
single
business
family
model.
home for rental model is exploding right now.
Yeah, yeah.
Yeah.
So, That's a
But
good
anyway,
point. The
to
other
your
thing I'd
point, the Federal
actually,
Reserve, they will say, is largely responsible for this, and the U.S. fiscal policy as well has also contributed to it. But they I think he's more of a Keynesian. For our listeners, that's John Maynard Keynes, who had the viewpoint that at times it makes sense for government to spend to try to help the economy get out of a funk. And I think he's probably more sympathetic to that view. But the Federal Reserve's policy of this easy money and printing money, he's not sympathetic to that at all. He thinks they're
yeah,
fools.
yeah, and he's been saying that for a while, right?
Yes.
And that's the other side too of this. Like I wonder, let's say he's right. We play that out. He's right. There's a super bubble. It starts to burst.
Hmm.
Is the Fed put still there? Right? Will the Fed still protect the markets? And if your answer is yes, then I think that's a challenge to believing
Hmm.
his theory. And I'm not by any means saying the Feds are just there to protect the markets. They're not. That's not what their mandate says. We could have a whole episode on this back and forth.
Right.
However, if rates go up too high, the federal government will not be able to meet its needs. So
I agree.
whether people talk about the Fed's independence or not, um, they cannot. They have a certain cap on how much they can raise rates. And Eric, on I wish I could remember which episode that was, but you previously broke those numbers down and
Hmm.
showed that on I think it was one of our episodes just talking about the spending on the way.
Right. We were talking about modern
Build back
monetary
better.
theory with Dr. Luigi Zingales and um, Bethany McLean,
Bethany
and
McLean, yeah.
that was a really great conversation. We just talked about the fact that if we have a $30 trillion national debt, and you raise interest rates on that debt from 1% to 3%, and then the federal government has to start to cough up not 300 billion to finance it, but 900 billion or $1 trillion a year. And people
Mhm.
say, well, that just sounds like a big number. Yeah, $1 trillion a year, folks, would be at least 25%, maybe closer to 30% of all of the tax receipts that they're taking in. At least 25 to 30% would be spent on just financing past spending. It's
Yeah.
crazy.
Yeah, and we also went over this in the episode where we looked at the Build Back Better plan. So
Hmm.
this theme, and we've talked about it on the podcast a couple times in the last 6 months, but this has been the conversation ever since there's been talk of raising rates after 2009.
Hmm.
And I've mentioned this before. I wish I could remember where I heard it first, but the assumption that stimulus is here forever, right?
Hmm.
Just because rate hikes are capped because of the amount that's been spent,
Hmm.
right? And if that is the case, if stimulus on in some form or another, if you just look at low interest rates as stimulus, if stimulus is here forever, how does a super bubble burst?
Hmm. Yeah, well,
Deflate, yes. Burst is what we're talking about, though.
Well, could you
uh-huh.
see it burst in like pockets, like certain asset classes, certain like individual companies, certain like commodities? Maybe it might not be this overall market where all prices are going down everywhere, but could it just be in like individual areas, which kind of seems to make the most sense on what you said? Maybe it doesn't burst, but some areas it might.
Well, go ahead, Roshan. What were you going to say?
Uh, that would when you break it down to the individual company level, I think yes, that is real, very realistic to expect certain companies, uh, stock prices go down, values go down. As the market overall, as I said, I can see deflating, and I'm not trying to make the argument that it's not going to burst. At the same time, I feel like as we're discussing this, the more we discuss this, I'm against this. It's not that I'm trying to wrap my head around it, and they're just
Yes.
to me. Um, I hold Grantham in high esteem. I think he's brilliant. I just find a lot of holes in this argument right now.
Well, fair enough. So the question is, as you pointed out, how much are we willing to gamble, I should say, or bet on the Fed put? So, listeners, if you're thinking, what does that term mean? So, the Fed put stems from a concept in the options markets known as a put option. And essentially, when you buy a put option, you pay a bit of insurance money, essentially, against the possibility that the markets will drop. And the concept of the Fed put is that you don't need to go out and buy that insurance because the Federal Reserve will provide that insurance for you, as it has done over and over and over again. And so why concern yourself with a downturn if the Federal Reserve has demonstrated that they cannot stop themselves from intervening to rescue investors? So if
Yeah.
if you believe that that is a permanent fixture of the markets, then why ever concern yourself with whether or not we're overvalued? Because so the argument goes, your only job is to buy the dips, not fear the dips, but buy the dips. Period.
Yeah, and I think that's a little extreme as well, right? Just to be out there and have no concern. I just
Mm-hmm.
wonder if because Grant, and I wish we mentioned this earlier. So for those who have stuck strong with us, he's talking about almost a 50% drop in the markets,
Mm-hmm.
right? So I don't think that just saying don't concern yourself with a decline is fair. I'm trying to have the conversation of, is he making a good case for a 50% decline? And
Mm-hmm.
barring some major, so, barring like pandemic, something unpredictable event. I mean, we're talking about this during Russia's invasion of the Ukraine, so there are unpredictable events out there that can lead to that. But just based on his data, and not using some kind of as Talib says, a black swan event, I
Mm-hmm.
don't. I just have a tough time uh, agreeing with that sentiment.
Well, to your point, then as evidence of that, there is the incurable instinct within the Fed to come to the rescue. What just happened here with this most recent downturn? The Federal Reserve had been expected to raise interest rates this quarter, or at least at after their next meeting, by a quarter, not just a quarter point, but a half point, and some thought perhaps 3/4 of a point, in response to raging inflation. Right,
Yeah.
the purpose of, in this case at least, or the lesson that people drew from Paul Volcker's work in the early 80s, 81 and 82, after Ronald Reagan had been elected, the two of them, but especially Volcker, said we've got to stop inflation, and raised rates. I think the 30-year Treasury went to 18% to try to snuff out inflation, and it worked. So the Federal Reserve was expected to raise rates in faster in order to combat this appearance now of, not just, I'm not saying the superficial appearance, but the emergence of what seemed higher than expected inflation. Well, in response to this market downturn, they've said, well, okay, maybe just a quarter point. So
Yeah.
again, backing away from doing what they should be doing, I would argue, in order to protect investors. So the Fed put, it seems, Roshan, has not yet died.
Yeah, and they are definitely have a tough job ahead for them, just because inflation is an issue, right?
Hmm.
We
Oh
talked
yeah.
about this on the modern monetary policy episode. It doesn't appear to be transitory. It appears to have a little more substance to it. There's probably a transitory portion of it, but they've got a tough job to figure out where they've got to do something about inflation. They've historically avoided cycles of raising rates as oil prices are up, and they've gone. Prices have gone way up with Russia's invasion of Ukraine,
Hmm.
and um, they also have to adjust to what's going on globally. I remember, I think it was in 2015, I believe it was December 2015, they had their first rate hike since 2009 when everything went down, and they had predicted how they were going to do like 4 or 6, I can't remember how many hikes in 16, and then there was the issue with China. So I don't think they did another one in 16, or they didn't touch it till the end of the year.
Right.
So we could see history rhyming, so to speak, right now with what happened then.
That very well could be. By the way, we maybe should come back to inflation. I'm still of the view that I'm still in the transitory camp.
Oh,
I do think that
completely.
there, yeah, I think, well, yes, I would say more so than I am than, these guys had it completely wrong, and we're in for a sustained, 5, 6, 7 type inflation rates. I don't think that's the case. I think we're probably going to settle in at 3.5. You're seeing it in vehicles a lot. You're seeing it in food a lot. You're seeing it now in energy prices a lot, but I don't know that those are necessarily permanent things. So anyway, but that's a different topic. But since you did touch on the inflation piece, I do think the Federal Reserve needs to address it. But I think the more important thing they need to do is to have rates return to some sort of normal level, but they're constrained, as we talked about earlier, by the fact that the more they raise them, the greater the debt service costs will be at the federal level.
Yes, for sure. For
So
sure. Yeah.
let's talk about some of the. We've talked about a number of the contributing factors that is part of their argument, that because we're talking about, is this real or is this not? So here's a couple other things that they've said are contributing to it. Earlier, I talked about evidence of it by the behavior, but here's what they would say is contributing to this bubble. So we've already talked about the super easy money policy of the Federal Reserve. Another is, if you look back over the last decade at how much retail investors have put into the markets, it's somewhere, I think, using or using flows into mutual funds and exchange traded funds. It's somewhere only, I think, about 45, $50 billion. It's not, it hasn't been a ton of money by retail investors. So what is driving the prices higher? To a large extent, it's institutional purchases, and those institutional purchases are coming in the form of companies buying back their own stock. By the way, doing so because they can borrow money so cheaply, so they buy back their own stock. Now, first of all, for a variety of reasons, I think this is a good thing that companies can. I think it's a good thing for investors who own those stocks, that what otherwise might be paid to them in dividends and therefore would be out of their control. It would be taxed if it's in a taxable account. Instead, if companies do stock buybacks with monies that they would otherwise distribute in dividends, then the investor gets the time when they realize that improvement in their portfolio, instead of getting taxed on it right then and there. But we also have to understand that a large part of senior executives of major corporations, the large part of their compensation comes in the form of equity compensation. And so they're strongly rewarded for having their stock price rise. And buybacks are a powerful way of making that stock price rise. So, in a sense, I'm certainly not, I don't want to be confused with Elizabeth Warren here, but I would say, in a sense, there is sort of even though I think it's good for investors broadly, I do want to acknowledge that this irresistible desire for them to borrow money cheaply and then buy back their stock is probably not going to stop anytime soon. If you continue to have relatively low interest rates, this institutional driver, is a powerful thing. And that, it seems to me, Roshan, also is an argument against it may not be an argument against a bubble, but it is that we're in one. But it might be an argument that we have to worry about that bubble popping, because I do think, again, these buybacks are fueling a lot of that price rise.
Well, and aren't the buybacks a good thing for if you're an investor?
Oh yes, that's what I was saying.
I mean, I don't have I can see why they're saying this is a contributing factor, and
Hmm.
if this were to go away, it would cause things to go down. But once again, if you believe rates are capped, this is not going away anytime soon.
I agree with that. Yeah.
So,
hmm
uh,
So, what the big threats then that they would say stem from all of this? Did you guys look at any of those threats now? The things that are threatening to pop it. Let's put it that way.
Yeah, please start with the list.
So one is inflation. So if inflation is in fact, if I'm wrong and it isn't transitory and it is there, we're moving to higher inflationary levels. What does that do? That puts pressure on things in a lot of ways, but it has a direct impact on corporate earnings, because if they're having to pay, they themselves are having to pay more for raw materials or labor, or the commodities that they use, if they're natural resource based companies, et cetera. If they're having to pay more for all of that, all else being equal, that puts pressure on their profit margins, and hence a result, since long term equity prices are driven by earnings. If earnings are, all else being equal, contracting, then price levels also, presumably, if they followed logically, would also contract. So that's the
And
inflation and
Eric, just a quick
earnings
question
connection.
for this. Wouldn't that
Mhm.
kind of be company specific? Because let's just take like a technology company that doesn't rely mostly on commodities or just like raw materials versus another company that does, where I know like kind of a concept that how to keep pace with inflation would be like equity stocks. Stocks are a good way to keep pace with inflation. But what you're saying is
Well,
inflation will be overall bad for the markets.
it's not like an instantly bad, but it puts downward pressure on, if it, to the extent it puts downward pressure on the earnings, as you said, of some sectors, then all else being equal, and that's an
Okay.
important term there, all else being equal, that puts understandably downward pressure on the prices. But to your point, Adrian, some companies like technology companies don't have those raw material pressures as much. And so what's a consideration in their case? Well, there's another factor, and that is the interest rates that we've been discussing. So let me help our listeners understand why any interest rate increase, or even the expectation of interest rate increases, puts pressure more specifically on growth stocks than it does on the rest of the stock market, particularly value stocks. Here's why. Why do people buy a company that's undervalued? Because they think pretty quickly it has the chance to turn things around, and that its price level is too pessimistically reflecting the actual capacity it has in the very near term to generate strong cash flows. But in the case of growth stocks, it's not because they're right now producing all of this bountiful cash flow necessarily. It's because they're expected in 5 years and in 10 years, their cash flows will have grown enormously. Their profits and earnings will have grown enormously. And so what you're trying to do is to get in early on those future cash flows. But those future cash flows, $1 million or $1 billion of cash flows 10 years from now, can't be treated as worth $1 billion today. It's discounted, we say. It's expressed in a value today of less than $1 billion. So what factor do you use to say how much less than $1 billion is that 10 years from now worth today? Well, it is some discount factor which is connected to the cost of capital, or said differently, it is connected to interest rates. If interest rates rise, then hence the deflation, or the deflator rises, or the discount factor rises, and hence those future $1 billion are worth less today. Hence, if that they're worth less today, then the stock itself, even at the same multiple of earnings, is worth less today. So that is, and you've seen that actually since mid-November, growth stocks have come down more than value stocks have done, and particularly those so-called disruptive or exponential technology companies, the ones that had zero earnings or almost very negligible earnings, but everybody was just banking on their future prospects and raising their capitalization rates to 10, 20, $50 billion. $50 billion on, what was it? Quantum Space, I think, is the name of the company. It was a company that's sort
QuantumScape,
of,
yeah.
yeah, QuantumScape. Thank you. So had 4 years away from even a sale of anything, let alone from making a profit. It was, I think, the market awarded it a valuation of $55 billion, which I think, if I'm not mistaken, is bigger than GM or Ford. That's crazy. So that those kinds of stocks have had a major slide, maybe 60% since their peak values a year ago. So the interest rate element, at least, is another contributing factor that as interest rates rise, their view is that that could be another contributing trigger to the super bubble in equities, at least, unwinding.
Yeah, which I think is in part why when the invasion happened, you actually saw markets go up, right? And I think what was going on there is they're saying, okay, well, if this invasion's happening, the Fed can't raise rates at the same pace.
Mm-hmm.
I think
Yeah.
that's part of what you were seeing.
Mm-hmm. So, well, listen. I just want to wrap the topic of, are we in one? Clearly, there's a lot of debate about it, and there are a lot of skeptics, and we've pointed to many. There's a lot of argument on both sides, even though we've honed in really mostly on GMO and Jeremy Grantham. But now let's talk about if they're right or if they're wrong. What are some of the implications? So, what do you think about that? If Grantham is right, what are some what steps should listeners take or consider taking
And you're saying if he's right,
if he's right? And then
if
what
he's
about if
right.
he's wrong?
Well, I guess what I was looking at is right or wrong. Your portfolio allocation and decisions before this has come out is really what's guiding you, right? So if you're someone who is and I guess another way to put this is if you think he's right, you want to limit your equity exposure, right? But the reason I say your portfolio decision in advance comes would have decided this would have decided this prior to even looking at his analysis, because if your risk tolerance and your goals put you down a certain path, I don't think this article really deviates too much, has you deviate too much from that path.
Mm-hmm, mm-hmm. All
So
right.
if you're a pure equity trader or someone who only invests in stocks, I think you read this as a starting point, and then you do additional research to see if you agree with it, and then that's where I think there could be a potential significant impact on your decisions.
Okay. I've got a few comments about it, but Adrian, if also have few thoughts about the implications, I don't
Yeah,
want to
from the equity
prevent.
perspective, I think one thing that they brought up is look at cheaper markets, where they're saying
Yeah.
right now, looking at the US, it's extremely overvalued compared to other markets in other countries, other areas. So begin your research and start looking there at other opportunities. And then obviously valuation is very key, where we talk. I think like the concept of growth versus value is going to be a really big discussion people are going to be having today.
Mm-hmm. Yeah, so I want to build on that, because I think what you just said is really important. So they would say, yes, we've been speaking about this bubble primarily in U.S. stocks and bonds, for that matter, and housing, for that matter, and somewhat in commodities and food prices, of course. But here's what they would say is, just as you said, if you look worldwide at valuations, what you find is that emerging markets don't have this extremely elevated price level relative to their earnings, relative to their sales, relative to their free cash flow, et cetera. And particularly if you look within emerging markets, for those companies that are indeed value companies, they're on sale in relation to their profits and their cash flows and sales and such. Then those aren't as likely to suffer a significant price adjustment, along with the stocks, that U.S. stocks, large and small. They'd also say, if you say, well, I'm not that keen on the emerging markets. Okay, so if you said, well, what about the developing markets outside the US? While they're not cheap, relative at least to the US, in these same valuation measures, the UK and Japan are much more reasonably priced. So you might look there for possibilities in terms of some of those investments. Then what about on the fixed income side? this is interesting. If another one of the groups that I follow and we've mentioned in previous podcasts is the group at Research Affiliates. Rob Arnott, Chris Bartman, Jason Chu, and a few others like this. And in their case, they also are saying emerging markets, particularly on the value side, offer the best opportunity. Developed world outside the U.S. is probably next best on the equity side, but also they're looking at their forecast real returns, meaning after inflation returns to, let's say, a 20-year Treasury is a -5 per year in real terms. So Grantham and their group are saying, to the extent that you put money into the fixed income category or the bond category, you have to look for specialized credit opportunities. You have to look for things that manage that accomplish the same outcome as fixed income is intended to, which is to protect capital and to provide some yield. But just don't assume that bonds naively are necessarily themselves going to be the solution for you. And for what it's worth, we've talked about some of those in our previous episode on what about bonds? We dealt with that subject somewhat. So in non-U.S. equities, emerging value in particular, specialized credit, and then some inflation hedges. And there, I think they're thinking about dabbling in some precious metals and in real assets of various kinds.
That is very useful for giving people, our listeners, a place to look into some of these things. And we will share the links to the white paper that GMO wrote, so you can review that yourself. Um, Gentlemen, anything to add? I personally was a little surprised at um, how much I was not a fan of this, as we surprised myself as we were discussing and recording this. But and by a fan of this, I like the episode, I like the discussion of this, but I just have a hard time agreeing fully with what they're saying. Adrian, Eric, anything that you'd like to add?
I just have a word for our listeners, but Adrian, do you have anything to add?
I don't. Eric, you can go ahead.
All right. So, listeners, we've talked a lot about this, and this is really a conversation for you to have. If you're self-directed, of course, then I would just want to encourage you to do a lot of reading. But if you're instead working with some advisor, I would really spend some time talking with your advisor about what their outlook is on this, and try to help just get your own thinking more clearly situated. You may come to the point of, hey, it's just unknowable, and I'm going to accept the risk of potentially a downturn in these markets and take the long view. Especially if you're younger, I think you have a little bit more of that luxury to do precisely that. And in fact, if you're younger, you may actually relish the opportunity for a super bubble to pop, a bunch of super bubbles to pop, because then at one level, assuming you don't lose your job, you've maybe housing becomes more affordable for you. Maybe as you put money into your retirement plan at work, you're buying assets now, many more shares of the same companies that were considerably more expensive just a few months or years before. You're able to buy in at much more attractive price levels. So you probably would love a 20-year period where you could buy things on the cheap. But if you're approaching retirement or you're in retirement, I really want to encourage you to have a conversation with your advisor. And if you don't have an advisor and would like one, we're here. And our contact information is available on our website, retirementlifestyleshow.com. And reach out to us. That's where we're helping clients in many conversations week in and week out sort through these kinds of questions and determine as a result what sort of positioning they should do with their portfolio to prepare them for a variety of possible outcomes, good, bad, or in between.
Yeah, I love how you said that, because it really does make a difference where you are and what stage of life, uh, as far as how closely you should monitor something like this and whether you should or shouldn't make any adjustments. So, very good point. I wish we had made that at the beginning as well. So, similar to talking about the data points. But to everyone that stayed strong with us, Thank you for listening. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, tell your friends and family about us. Give us 5 stars, share. We really appreciate your support. We'll be back next week. This has been another episode of the Retirement Lifestyle Show.